In the UK, we're a nation of checkbox business owners. We do exactly what the law requires to avoid any trouble. We insure the £50,000 van because the law says we must. We insure the office because the lease demands it. We protect the stuff perfectly. But there's an imbalance in our logic. We're meticulously protecting the golden eggs, while the goose, the person generating the £2 million revenue, is often left completely exposed to the elements. If the van breaks, the business continues. If the wealth engine stops, the whole structure can collapse. Today, I'm showing you how to close the gap between being compliant and being secure. We've got to distinguish between liability and legacy. The law's primarily interested in liability, making sure that if something goes wrong, there's a mechanism for payment. But the law doesn't care about your legacy. It doesn't care if your business survives your absence. Being compliant simply means you've met the minimum requirements of the state. Being safe means you've accounted for the mathematical reality of your company's survival. Your risk assessment is currently upside down because you're valuing inventory over intellect. Think about it. If your warehouse burns down, your customers will wait for a restock. But if the brain of the operation disappears, your customers don't wait. They look for a new partner. The law protects your physical assets. Only structure protects your market position. Let's look at the math. If a £50,000 piece of equipment breaks, it's a speed bump. You call the insurer, get a check, and buy a new one. But when a key person, perhaps that's you or a top director, is no longer there, you can't just buy a new one on Monday. They take the relationships, the momentum, and the institutional knowledge with them. You've insured the furniture in the car, but you've left the engine completely unmaintained. That isn't a strategy, it's a structural flaw in your business continuity plan. You're treating a person as an expense on a P&L statement when they're actually the primary asset on the balance sheet. Most owners think a person's worth their salary. They think, if Steve leaves, I save his £80,000 salary. That's small-minded math. If Steve was responsible for £1 million in contracts, you didn't save £80,000, you lost £920,000 in margin. But it's worse than that. There's the momentum penalty. When a key figure disappears, the remaining team enters a state of decision paralysis. Projects stall, sales cycles double in length. Then you've got the recovery cost, recruitment fees, signing bonuses, and the 6-month lag where productivity hits zero. While you were busy insuring the £50,000 van, your £2 million engine was hemorrhaging the company's future value. We need to value people at their contribution level, not their cost level. There's a risk the law never mentions: credibility. In the UK market, your banks and your major suppliers are watching you. If they realize that the entire £2 million enterprise rests on one unprotected person, they view you as a high-risk gamble. The moment that person's gone, your credit lines can be reviewed and your suppliers might change their terms. They aren't being mean, they're being logical. They see a key person gap and they realize the business might not have the lifeblood to fulfill its obligations. Protecting that person isn't just about money, it's about signaling to the market that your business is built to last, not just built to exist. The law is a floor, not a ceiling. It's designed for the average. And average businesses in the UK fail every single day because they only do what they're forced to do. Now, this is where most business owners get stuck. They ask, how do I even begin to value a human being's contribution to my firm? You don't value the person. You value the impact of their absence. You look at the net profit that person's responsible for. You look at the cost of stagnation. You've got to calculate what we call the liquidity injection required to keep the lights on while you find a replacement. If it takes 12 months to replace a £2 million revenue generator and your margin is 30%, that's a £600,000 hole in your cash flow. If you don't have a structure that injects that £600,000, the moment they disappear, you aren't running a business, you're running a countdown clock. You need to stop looking at insurance as a cost and start looking at it as capital injection for continuity. I have put a list of resources for you in the description of this video. If you want to be an elite owner, you've got to look at what the law doesn't require you to do. It doesn't require you to stay in business. It doesn't require your family to inherit a functioning firm. Because this math is specific and the structure matters, I've recorded a private key person masterclass. I break down exactly how to value a wealth engine and how to structure protection so the business survives and the family thrives. Don't let legal minimums dictate your financial maximums. Go look at your insurance folder today. If the stuff is safe but the soul of the business is at risk, you've got work to do. You're either an accidental business owner or a deliberate architect of wealth. Architects don't leave the engine of their enterprise to chance. Click the link below, watch the masterclass, and let's move you from compliant to protected. I have put a list of resources for you in the description of this video. I'll see you in the next level.